It's a shock from the top. You're not going to believe what they're trying to hide. Stay tuned. And tonight's show is brought to you by GCL Global Holdings. You can find them on the NASDAQ under symbol GCL. And they're revolutionizing the gaming industry with their dynamic portfolio and strategic vision. And their stock right now is looking at a 20% upside move as it just experienced a Bravo 9 breakout right inside a rising channel. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, as you're about to see, I've been warning about this for a while, and those at their top are starting to get desperate, and in a big way, as the Senate introduces a bill for tariff rebate checks after Trump's suggestion. Now, I want you to understand the last time we did a rebate check was during the pandemic because the global economy was shut down. And if indeed the economy was booming, the labor market was strong and robust, and consumers were out spending in a major way, this wouldn't be necessary. So what I want you to see here is the reason behind this has everything to do with the economy. It's going the wrong direction, and the problem is nothing seems to be changing the trajectory. This is exactly what I've been warning about. As Senator Josh Hawley on Monday introduced a bill to send tariff rebate checks to American families, this would be similar to what happened during the COVID-19 pandemic and has everything to do with demand. Because what have we been seeing from consumers? That their spending is declining. And this has been happening because prices have been rising, but more importantly, paychecks have been shrinking. So how do you stoke the economy? Well, if everything else you're doing isn't working, if the tax cuts aren't driving demand, if the trade war isn't driving demand, well, and the Fed isn't cutting rates, well, the only thing left is to send out checks. And let's talk about what the idea is here, because if enacted, the American Worker Rebate Act of 2025 would provide at least $600 per adult and dependent child, or $2,400 for a family of 4. The bill will allow for a larger rebate check if tariff revenue exceeds projections. We're going to take a look at some of those numbers here in a moment, but whatever the final amount would be, the benefit would be reduced by 5% for joint filers with an adjusted gross income above $150,000 or single filers earning more than $75,000 a year. Now, I'd love to know what you think about this. Is this something the government should do? Should we be using it to pay down debt? What do you think? Weigh in the comments below, because when we look at the estimated cost of this, we're talking $166.65 billion to fund this. Now, if revenue goes up, well, that means the cost could go up even more. But how much money have we brought in so far year to date from the tariffs? Well, we brought in about $95 billion. So the estimates here suggest that if those numbers continue to flow in, that this bill could be entirely funded from the tariffs. But the problem is, as we look at the economy, would this cause inflation? Because remember, that's what happened during the pandemic, and that would be a major issue. As we know right now, the Trump administration and a lot of political elites want the Fed to cut rates. We're going to talk more about what the Fed did today later in the show. Now, if you're looking to increase your income, well, look no further than our stock for our sponsor for today's show, GCL Global Holdings. Let's take a look at the report from my newest trading program. It signaled 3 buy signals across our Metre strategy, the Bravo 9, and a rising channel strategy. And check this out. You can see very clearly the stock is rising up this channel and looking to break out. If it touches the top end of that channel, could be a 20% move to the upside. Again, check them out on the NASDAQ under symbol GCL. Like President Trump proposed, my legislation would allow hardworking Americans to benefit from the wealth that Trump's tariffs are returning to this country. But one of the problems we're facing right now is a lot of Americans aren't feeling wealthy. We see that in the sentiment surveys. They're worried about their job. And even worse, they're worried if they lose their job, they can't get another one. And then what did we talk about yesterday? That wealthy Americans are starting to fall behind on their credit card and auto loans. So what we're seeing in the economy is exactly what we've been warning about for a while, is that the trajectory is going in the wrong direction. And now we're starting to find out that it's impacting more and more people. So it starts to make sense of why you're seeing this panic coming from the top. They're desperate to do something because this all comes down to consumption. And right now, that means real retail sales. Let's take a look at this chart. Again, this is real retail sales. That's inflation adjusted. But let's look at the real issue. And you can see it right here as we saw all of that front running of demand. And what happened? consumers pull back. And it has everything to do with the outlook of the job market. They're seeing their pay rate start to slow down. They're seeing the amount of hours they get drop. And what we know is already, again, we go right back to all of those delinquency rates, and we can see the economy isn't working for a lot of Americans. Now, the problem for corporate America is they built up massive amounts of inventory, and they're not moving. And that inventory needs to move. And if it doesn't, what you're going to see at the manufacturing level is layoffs are going to rise, and you're going to see it cascade all the way down to the retail level. And the evidence is getting clear that Americans can't afford higher prices and the economy isn't working for them. As we now turn to Starbucks, and what we find out that same-store sales fall again, but CEO Nichols says the turnaround is ahead of schedule. Well, maybe it's not as good as he thinks, because overall their net sales rose 4% to $9.5 billion, meaning prices went up because same-store sales declined 2%, which is a steeper drop than estimates saw. So what we're seeing here is the evidence that we're seeing from consumers all around the world. They can't afford higher prices, and every time they go up, demand goes down. So you can see why from the government level, one the only remaining solutions isn't going to be a rate cut from the Fed, because that's not going to get people to go out and buy coffee. It's a direct stimulus check. And what this is telling me very clearly, that they're starting to panic right at the top. And there's further evidence as we turn to Cisco, as they cite consumer woes for outlook that's below long-term target. Now, this is a major issue here, because when you talk about a booming economy, one thing that you can really look at and see that consumers are excited and they're feeling wealthier is they go out to eat. But what Cisco is warning about is that people are cutting back in a major way. In fact, earlier today, I was talking to one of my friends in the service industry, and around here where I live in Orlando, it's not uncommon for people to have a full-time job and a part-time job. He says, yeah, I've got that, and now I'm looking for a third one. So you could see there's stress all across the services industry. Overall consumer sentiment and confidence, quote, is not high right now. And that's a major problem, because when you look at household finances, when things start to get worse, the first thing households do is cut eating out. And now we're seeing evidence from that from Starbucks and from Cisco. We heard that from Chipotle and some other places. What is clear evidence is the economy's going the wrong direction. But one of the challenges right now is the government report that everything looks really good. But underneath that, I'm going to show you why this latest GDP report is going to reverse hard in the quarters to come. As the U.S. economy rebounds with a 3% GDP growth after trade reversal. And you would think with numbers like this, there would be a lot of excitement about how great the economy is doing, and there wouldn't be a need to do a stimulus check. But again, as you pull back the covers, you find out that this report was nowhere near as good as the headline suggested. Beyond the recent tariff-related swings, second quarter economic activity was more moderate. Consumer spending, again, this is the key one here, which accounts for 2/3 of GDP, advanced a mere 1.4%, marking the tamest growth in consecutive quarters since the pandemic. So what do those at the top know? That GDP number was due to front-running of inventory. It wasn't due to consumption. Again, that's a major issue here, because as consumption goes down, the demand for employees goes right along with it. Trump hailed the GDP number in a social media post as, quote, way better than expected, and renewed his call for Fed Chair Jerome Powell and his colleagues to lower rates. But you see some conflicting information here, because if indeed the economy was booming and we're seeing the GDP at 3% with the expectation was going to rise, then you wouldn't need rate cuts. You wouldn't need stimulus checks. So you can see very clearly what they're trying to hide, as the fact is that this GDP number is about to roll over. And here's the evidence. Let's take a look at this chart of real retail sales, still shown in blue, against real, that's again, inflation-adjusted gross domestic product in red, both on a year-over-year rate change. And as we zoom in, what do we find out? Let's go back to the dot-com bubble. You can see in the years leading into it, real retail sales went down, and it brought GDP right along with it. The same thing happened during the global financial crisis, and based on what we're hearing from consumers and we're seeing how they spend, what we can expect is retail sales likely to go down. That means in the coming quarters, GDP likely to head lower, meaning what we're seeing from the tax cuts and the trade war isn't benefiting the average American. And again, the evidence is clear. As we go back to yesterday's show, we wouldn't see rising delinquencies in the wealthier American cohort if that was happening. In fact, that's been happening over the last 2 years. So you can see the financial stress that's happening is affecting everybody, and the problem is it's getting worse. Because swings in trade and inventories have been distorting overall GDP this year, again, putting artificially high numbers as economists have been paying even more attention to final sales to private domestic purchasers, a narrow metric of demand. And this measure rose at a 1.2% pace in the second quarter, the slowest since the end of 2022. So this is exactly what we've been warning about. And this is what the political elites are seeing. But one of the problems right now that we have is with the labor market, and we're getting a lot of distorted numbers from this. Now, we'll get the official numbers from the government on Friday, but let's turn to the ADP, who notoriously gets this wrong. As U.S. firms add 104,000 jobs in ADP data, more than forecast. In fact, everyone was shocked when this number came out because it didn't make any sense. Now, keep in mind, the ADP data is way off from the federal non-farm payroll report. So what this was likely them doing is adjusting from the fact that they printed negative last month. The non-farm payroll report printed, of course, remember, a positive number. Now they're trying to play catch up. But our hiring and pay data are broadly indicative of a healthy economy. This from Nella Richardson, the chief economist at ADP. Employers have grown more optimistic that consumers, the backbone of the economy, will remain resilient. And Nella, I couldn't disagree more with you. I don't think that's true at all. In fact, I think the evidence is very clear that the opposite is going to happen, and that your payroll report here is not indicating what the truth is in the economy. Let's take a look at that chart again of real retail sales, still shown in blue, but now overlaid with the continued claims data. And you can see here's the real issue. ADP is telling you, look, the labor market's strong. But one thing we know is when retail sales move to the downside, as you can see each and every time, it has an impact on labor. The demand for that goes down. Now, the real risk is as paychecks shrink, we're going to see retail sales go down. And that means we're going to see continued claims go higher. Now, we've seen it slowly tick higher. We'll get, of course, the official data on that tomorrow, but the issue is the economy isn't working for people. You wouldn't see more Americans go into delinquency if the economy was going in the right direction. And remember, delinquencies lead to less demand, less retail sales, and along with that, a lower need for employees. But meanwhile, where ADP said workers who changed jobs saw a 7% increase in pay, while those who stayed put saw a 4.4% gain, and this is based on a 25 million U.S. private sector employees. But again, I completely disagree with the view here that this is all about pay growth, because that's what Nella said. Hey, look, we're seeing is everything's okay. Look at our 104,000 print. Look at the fact that pay growth is holding up. But there's an issue here. Pay growth tends to rise even through a recession for those who have a job. But let's take a look at this chart as we overlay average hourly earnings of production and non-supervisory employees in blue against average weekly hours of production and non-supervisory employees. So what happens is you go back and see going into every recession, employers are saying, look, we'll give you a pay raise, it's not a problem, but at the same time, we're going to cut your hours. And that's the issue here. You see that relationship going into every recession. So right now, hours worked are dropping. And again, we'll get the official number on Friday, but Nella wants you to believe that, hey, average hourly earnings are holding up. But when you put that into context, it still means paychecks are shrinking. But does this mean the Fed's going to run to the rescue? Well, it doesn't, because they helped put. The Federal Open Market Committee voted 9-2, just as Wall Street said they would, on Wednesday to hold the benchmark funds rate in a range of 4.25% to 4.5%. Governors Christopher Waller and Michelle Bowman voted against the decision in favor of a quarter-point cut. Again, that wasn't a surprise because everybody knows that they came out and said we were going to vote against this, and there's the belief that both of them want to be the next Fed chief. And of course, we know President Trump said he or she who cuts or wants to cut will be the next Fed chair. So obviously they're in run for that. But in their statement, central bank officials repeated the view that the labor market is solid and inflation, quote, remains somewhat elevated. So now we're hearing a change in messaging from the Fed that we didn't see the inflation that we thought, but they're still worried. They still said there's uncertainty going forward because they believe there's going to be a spike in inflation, despite the fact that there's absolutely no evidence to show that. Because there's one real issue here. As the demand for labor goes down, as hours work drop, what you find out is people can't afford to go and shop. That's exactly what Cisco and Starbucks are starting to say. And as they go into delinquency, their spending goes down and price increases get very difficult to pass on. And this is exactly why Christopher Waller has been warning that private sector payrolls have shown signs of weakening, and that informed his view on the descent. And that is the issue here. We continue to see the labor market unwinding, which is exactly why the government's looking at doing a stimulus check, because they know what the truth is. They know the economy is going the wrong direction. They know nothing's working. And all else fails, you go right back to stimulus. It's the one thing we do know that works. That is, unless, of course, people use it to pay down their debt. We don't know what would happen because we don't know if this is going to pass. But the issue at hand is the government's trying to cover up a slowing economy. And the worst part is they know it. But something we're bullish on is a stock for our sponsor for today's show, GCL Global Holdings. Again, you can find it on the NASDAQ and symbol GCL. Everything you need to know in the pinned comment and description below, because they're a powerhouse in the gaming industry as they operate across game development, publishing, distribution, and gaming hardware, positioning themselves as a leader in both digital and physical gaming markets. With a focus on innovation and global reach, GCL is shaping the future of gaming, one story, one experience, and one player at a time. And they distribute over 8,000 game titles worldwide, including some of the fastest selling games ever. From physical games to digital keys and direct downloads, their extensive catalog caters to diverse gaming platforms. And their vast portfolio ensures that GCL captures a significant share of the growing gaming market. And GCL is expanding its influence through strategic moves like a pending acquisition set to close in the first quarter of the fiscal year 2026. This acquisition will strengthen their hold in high-value game IPs, enhancing their market position. Their ability to navigate market dynamics with data from sales, marketing, and IP stakeholders drives sustainable growth. And GCL is a 20% stakeholder in Netcom, the global publisher of Schwana American Story, a highly anticipated title generating significant buzz, especially after the success of games like Black Myth Wukong. Set for a Q4 release, this game could be a game changer for GCL's portfolio, tapping into the demand for premium 3A titles. And GCL's strong IP portfolio, including titles like Stalker 2, opens doors to transmedia opportunities. From games to merchandise and potential film adaptations, GCL is poised to monetize its IP across multiple platforms, amplifying revenue streams and brand visibility. And the upcoming Nintendo 2 Switch launch is expected to drive a spike in game demand, and GCL is perfectly positioned to capitalize. With each new console generation, related game sales soar, and GCL's global distribution network is ready to meet this surge. And GCL thrives on the symbiotic relationship between the video game and consumer's electronic market. This dynamic drives innovation and unlocks new growth opportunities, positioning GCL at the forefront of a rapidly evolving industry, and something we think could surge a whole lot higher, and that is their stock. Again, you can find it on the NASDAQ and the symbol GCL. And looking at our newest trading report, you can see it triggered a buy signal across our beta strategy, Bravo 9, and channel trading. Now, Bravo 9 is when you get a trade above a rising 9-day moving average. Here you can see it's been rising above this 9-day for several days in a row, and you can see it's in a rising channel, looking to make a move to the upside of that channel, which could realize a potential 20% gain. Again, you can find them on the NASDAQ under symbol GCL. And GCL Global Holdings is more than a gaming company. It's a visionary player shaping the industry's future. With a robust portfolio, strategic acquisition, and a finger on the pulse of market trends, GCL is well positioned to lead in gaming innovation. Stay tuned to GCL's journey as they continue to redefine gaming experiences worldwide. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.